Hello, everyone, and welcome. As many of our subscribers will know, the city of Cape Town will host the annual Africa Mining Conference this month, bringing together government stakeholders, investors, and operators, all around a shared question. How do we mobilize capital into African mining at the scale that the global energy transition now demands? Africa sits at the epicenter of future demand for copper, cobalt, lithium, and many other critical minerals. Yet, despite the strategic position, the continent continues to face a multi-billion-dollar financing gap in mining. If we just look at exploration spending, for example, this averaged over $470 million a year between the period 2015 and 2024. Yet Africa's global share actually fell 3.6% over that same period. At the same time, the continent captures less than 1% of the value from processing and manufacturing its minerals. Much of this comes down to how risk is understood and priced within the sector. Our starting point at Pangea Risk is that mining risk in Africa can often be mischaracterized. Sovereign risk scores, headline political narratives are certainly useful, but they can flatten complexity. They can conceal project-specific risks that really matter for bankability, while at the same time overstating exposure where risks are in fact more manageable. Today, we want to focus on two things. First, why mining risk behaves differently from other sectors. And secondly, how looking more closely at the life cycle, the local and sector-specific dynamics can materially change the investment environment. I'm joined today by Zainab Persson, our Senior Africa Analyst, and Jack Brodsky, our Country Risk Analyst, to unpack the opportunities and risks investors, lenders, and operators face in Africa's mining sector. Now, Jack, I want to start with you and turn towards West Africa, which remains one of Africa's most important gold regions, but is also where we've seen some of the sharpest political interventions in recent years, and certainly ones that are perhaps more reflexive of traditional examples of country risk in the sector. Can you take us through some of these recent dynamics in the region and what lessons can be learned around understanding risk in the mining sector?
Thank you, Gabby. Well, despite a recent correction, the price of gold has risen by nearly 80% year on year, with uncertainty around tariffs, sanctions, and policymaking, reflecting a lack of confidence in dollar-backed assets, and gold presenting itself as a more stable, secure commodity. And alongside this, global net zero targets have driven a surge in demand for critical minerals. The market for copper, lithium, nickel, cobalt that power our cars and mobile phones has arguably never been greater. But here is where it gets interesting. And while Africa holds an estimated 30% of the world's critical mineral reserves, as you mentioned, it captures less than 1% of the value from processing and manufacturing them. Conscious of this apparent disconnect, governments across West Africa have implemented new legislation to reclaim much of this dormant value. Most recently, we heard that the Ghanaian government are rewriting investment stability agreements in the mining sector, with proposed reforms seeing royalties surge up to 12% as long as gold maintains a value of 4,500 US dollars or higher. Looking further back than this, military governments in Mali and Burkina Faso implemented new frameworks that increased national ownership in mining projects. A long-running dispute between Barrick Gold and Assimi Goïta's government saw operations at the Loulo-Gounkoto mine suspended for several months. The result of this was that industrial and gold production was considerably lower than the initial government forecast. Alongside this, 4 staff members of the miner were detained and released only when the company paid out over $400 million to the government. This tactic, of course, does carry risks, but governments are weighing up that investors will not be scared away into alternative markets. Of course, if royalties and investment conditions go too far, governments will end up on the wrong side of the Laffer curve.
It's very true that it's a delicate balance when it comes to dynamics in West Africa, but perhaps give us a broader view of the region. what should investors consider when they look at West Africa as a market today?
Well, for investors looking at West Africa, I think assumptions and oversimplifications will represent the enemy of opportunity. In a region of 16 nations, over 500 million people, 5 military governments, investment risk is going to vary considerably. Whether by geography, sector, or commodity, it can be limiting for investors to rely exclusively on sovereign level ratings or broader aggregate risk scores. The African Development Bank has argued that fixed, narrow risk models may overestimate risks in African countries, imposing the African premium on mining and infrastructure projects that have actually paid out to investors. Last year, Dr. Akinwumi Adesina, former president and chair of the AFDB, quoted a Moody's study that found that high premiums haven't caught up to the fact that African infrastructure investments have had a much lower loss rate than counterparts in Latin America or Eastern Europe, with a loss rate of 1.7% in Africa compared to 13% in LATAM and 10 in Eastern Europe. In a similar vein to this, a 2024 report released by Africa No Filter revealed how negative stereotypes pertaining to violence, electoral fraud, corruption were proven to be more commonly attributed to African countries than peer countries from other continents with arguably very similar risk profiles. This Africa No Filter report found that due to negative stereotypes and media coverage, African countries were potentially losing up to $4.2 billion per year in interest payments alone. And this figure, of course, doesn't even take into account the losses incurred by investors being deterred by this crisis or risk-focused media coverage. This is all to say that critical country-specific data assessments, which properly take into account local conditions, dynamics that vary, as I said, across sector and geography, can really help eliminate blind spots and create new opportunities for capital investment. In West Africa, a region so rich in mineral resources of gold, bauxite, iron ore, lithium, so crucial for modern economies, it's vital for investors to be able to separate the signal from the noise and find opportunities in the coming years.
Thank you, Jack. Some really key insights there. Now, Zainab, I want to bring you in. Obviously, we focus on West Africa, but I know you keep a very close eye on the mining sector for Pangea risk, looking at Southern Africa and Central Africa as well. And it could be argued that these, represent a very different operating environment to that in West Africa. So how does country risk typically manifest relative to the mining sector, of course, in, say, the DRC or even Zambia? And what should be front of mind for investors, lenders, operators in these types of jurisdictions?
Thank you, Gabby. This is a really interesting question, and it comes up a lot when we talk about mining in different parts of the continent. Now, in Southern and Central Africa, country risk in the mining sector usually doesn't show up as sudden expropriation or asset seizures. It's much more about policy uncertainty and political volatility. So in places like the DRC and Zambia, which are Africa's top copper producers, mining is politically and fiscally critical. So when governments come under pressure, they tend to intervene in the mining sector. And this often shows up through changes to tax terms, changes to export rules, local processing requirements, or even licensing reviews. And we most recently, of course, saw this with the DRC's cobalt export ban last year, which has now been followed by the imposition of an export quota system. Now, in practice, what this means is that it is vital for mining stakeholders to assess each project for its unique risk exposure, specifically in relation to its political importance, but also the specific location, as Jack has mentioned. The specific location in many of these African jurisdictions play an important role in influencing risk exposure.
You. Well, certainly a lot to think about there, but I actually want to end this discussion on a more positive note. Obviously, with looking at investment in Africa, there's a lot of opportunity as well. Zainab, can you tell us about some of the initiatives in these jurisdictions that aim to address some of the challenges operators may face so that they can leverage that opportunity?
Yeah, sure. We always like to end on a bit of a positive note instead of just scaring everybody away from the continent. But so there are some genuinely encouraging initiatives that are underway. And one of the most important ones, which I'll mention that will impact the DRC and Zambia specifically, is the development of the Lobito corridor. So this will be this is a railway that runs from the Copperbelt region to Angola's port, and by improving access through rail and port services in Angola, this will help address long-standing logistics bottlenecks and also lower transport costs while reducing the reliance on the congested road export routes, which miners have to currently make use of. Then, beyond logistics, staying in the Copperbelt region, the DRC has driven some progress in digitizing its mining customs processes, which aim to reduce administrative burdens that have been weighing on the efficiency of mining operations, while Zambia is also trying to improve its power supply, which is something that has been that has been a challenge with the ongoing drought, and it is hoping to do so while also scaling up copper output, which we have seen bear some fruit over the past couple of years. So, taken together, these are perhaps baby steps towards where we would like to see the region, and they do not perhaps eliminate risk completely, but they do meaningfully improve the operating environment, and we do see some effort from these government sides to address the challenges that mining operators face in the region.
Well, thank you for that, Zainab, and thank you to Jack as well for these insights on such a strategic and important sector. As Africa's role in the global energy transition grows, the opportunity is not just to deploy more capital, but certainly to deploy it more precisely. Thank you for joining us, and as always, Pangea Risk remains ready to support our clients as they navigate the diversity and complexity of their target sectors and markets. Thank you all.